I'm wondering about your take on the Fed, because you expect, I think, still 3 rate cuts this year. And I don't understand exactly why the Fed needs to cut. Rates don't seem very restrictive. We have 2.5% growth, I think, is your forecast for 2025. We have an S&P 500 that's up another 24% after a 24% gain. Unemployment is very low, still much lower than the historical average. Why does the Fed need to continue to cut?
I'd say 2 things. One, the funds rate is still quite high. We're still 100 basis points or so above many people's estimates of the equilibrium funds rate, or we're in our case 75 basis points. It's a little more than 100 basis points in the Fed's case. So I think there's a presumption that if nothing else happens, the funds rate's more likely to come down just to get back to something closer to equilibrium, at least as long as inflation still trends down, which is our expectation. And number 2, we have seen a labor market rebalancing, and in fact, some signs of weaker labor market activity, certainly on the hiring front. We're also looking for a somewhat softer employment number on Friday. Obviously, that's only one report. We'll see what it prints. We're at 125 for payrolls, and we think that the unemployment rate might edge up to 4.3%.
Right.
And 4.3 is low, but it's not super low. It's no longer in the 3.5% range, and it would be a touch above the Fed's estimate of the natural rate of unemployment.
So just to clarify quickly, so 3 rate cuts in 2025, that would be normalizing. It wouldn't necessarily be easing from the Federal Reserve.
Yeah, that's a question of terminology, but I think you could put it that way, that it's normalizing rather than really easing.
Okay, so maybe a distinction without difference, but words matter here, Jan, and we haven't talked about Donald Trump yet. And it feels like when you talk about the Fed, when you talk about the inflationary outlook, even when you talk about growth, you have to talk about tariffs. What is your base case for tariffs right now? And I know it's hard before the man even gets into the office, but what are you expecting there?
We're building in tariffs on China, so a 20 percentage point increase on average in U.S. tariff rates on China, and we're building in auto tariffs on the European Union and Mexico. Beyond that, and that gives us a modest negative impulse to growth. By itself, there are some other changes in policy that are more growth positive, but a few tenths of growth. And we have about 3 or 4 tenths of additional inflation in 2025 because of the tariffs. With that, we still have inflation coming down from 2.8% now to 2.4% by the end of the year, but we'd be very close to 2% if it wasn't for the tariff impact. So it's a sort of mixed impact. I think markets have very much focused on the fact that you probably will see somewhat more inflation in the short term. They've taken that as quite hawkish, but it's double-sided. You have it on the one hand, you have an inflationary impact. On the other hand, there are also some risks to markets if we were to see a more aggressive tariff posture, which of course is a risk. We don't know, as you said.